Hello everyone, it's Billy Abrams, CEO of ADM Securities, and myself, Alex Suslov, Head of Capital Markets at AD Mortgage, here today with you for our weekly market digest.
Hello everyone. Hello Alex.
Hey Billy, I used to play hockey a little bit when I was a kid, but never been in a big sport in hockey. What's going on in the big arena?
Well, looks like tonight we start the Stanley Cup playoffs. I wore my Florida Panthers tie.
Nice,
This was designed by a Hall of Fame hockey goalie that played for the Panthers and the Rangers.
Really?
So it should make everybody happy. Yeah, and I'm really excited. So
Great.
We have a good couple of weeks, actually probably a couple of months, I hope. So looking forward to it.
I love the support to our home team.
There you go. There you go.
For the economy news, Billy, for this week, all eyes are on Fed, right?
That's correct.
We're waiting for the Fed's meeting happening on May 4th, waiting for the results that Powell will give us. And I believe market today is pricing the 50 bips hike, correct?
That's right. The big news will come from the Fed. What's been interesting is the last week, since we sat here last time, I've got down about 8 economic numbers that came out. Only 3 of which were actually market negative. Wholesale inventories, advanced GDP, actually market positive. Wholesale inventories were higher than expected, which is negative for the economy. A lack of orders. Advanced GDP came in lower than expected, but the GDP price index came up much higher than expected. So that's kind of an offset. And everything else was durable goods were slightly weaker than expected. Core durables were quite a bit stronger than expected. So that's a market negative report overall. Richmond Fed was much stronger than expected, and new home sales fell less than expected. Pending home sales did. New home sales were lower than expected, but with a big upward revision to last month. So by and large, the numbers were negative, and yet, after I invoked Groundhog Day at the last digest, for the first time since we've been doing this, yields are lower today than they were a week ago. And that doesn't even tell the whole story. The 5-year rallied 30 basis points this week, but it gave back a lot of it. I think this is two-sided trading that we'll see in front of FOMC. We'll see it for another couple days as people even up positions and get set and wait to see if that news is what they want to hear or what they don't want to hear.
I saw 2-year Treasury yields were bouncing, were very volatile, and I saw a 15 basis point move down and back again, right?
Right. The 5-year rallied 30 beeps and gave back about 25 of it. So
that's a lot.
I think what FOMC is going to determine is whether this is the beginning of a big correction or the end of a little one. I do think a big correction is coming, and I would imagine yields will be dropping by the time we sit down again. The question is, if the FOMC news is taken well, we'll be in about the 3rd week of the correction, and if it's not, we'll be in about the 2nd day of the correction. So we'll just have to see what happens right after the news.
And you mentioned GDP numbers came in lower than expected and even negative quarter over quarter. What does this drop in the GDP growth shows us in the economy?
I think that can become a concern, and the reason I think it can become a concern is the Fed has got a juggling act in front of them. They're going to raise interest rates to try to quell inflation, but they have to do it in such a way as to not to hurt the economy. So if the GDP continues to show bad numbers, it puts them further behind the 8 ball. But at least right now, nothing is that disturbing. I don't think anyone is terribly surprised by it. It's a question of what we see going forward. There's another very important number that will come out today, and that's the PCE price index, which is the Fed's #1 barometer for inflation. So I don't think it will impact their decision. I think they've made up their mind what they'll do. But that's a number we'll want to watch going forward.
To remind our audience, we see conventional rates today at 5.1% and non-QM rates at 6.9%. By the way, Billy, you know what's the interesting point? We see investment loans in non-QM sector in debt service coverage ratio program rising due to increase in the rates. A lot of borrowers are switching from conventional investment programs where they need to provide income and go through tedious underwriting process. They'd better take about 1% higher rate and do DSCR program. That's why we see such a growth in non-QM DSCR space.
Correct. And one of the things that I think is important, a little blip that I saw, was that Freddie Mac estimates that there's a housing shortage approaching 4 million units. And as long as there's a housing shortage, rising mortgage rates typically are not going to help the housing market. But a small inventory will. Supply matters. It's a supply and demand market. So the shortage of housing should keep that market strong, and it should keep the products that we do, the non-QM products, in demand.
Absolutely. We're looking to host a webinar on May 3rd on jumbo programs and ease of use DU for qualifying for a jumbo loan. In May, from 15th to 18th, Billy and I will be attending MBA conference in New York. We are welcoming everyone to attend our corporate event on May 16 in Belvedere Hotel. Billy and I will be there, and we'll be looking forward to see you guys.
And let me add that I will spend most of 2 days at booth number 401, and I hope you'll all drop by and come see me.
That is perfect, Billy. So we look forward to seeing everyone there. That was Billy and myself, Alex, with our AD Mortgage Digest.
Thank you, everybody.
Stay tuned.